Carol from Wisconsin opened her brokerage account on a Tuesday morning in March. She was 62, 3 years from retirement. She had done everything her financial plan said to do. Index funds, a 60-40 split, steady contributions for 28 years. Her account was down $74,000 in 6 weeks. She hadn't made a single bad decision. She hadn't chased meme stocks. She hadn't bought crypto. She had followed the standard playbook exactly as written, and the standard playbook had no answer for what was happening. Her husband Ray had a separate account, same household income, same years of investing, different assets. His account was down less than $9,000 during the same period. Same family, same starting point, completely different result. Carol spent that weekend researching what Ray owned. What she found is what this video is about. 4 specific asset categories that show up in the historical record, decade after decade, doing something important when everything else is falling apart. By the end of this video, you will know exactly what those 4 assets are. You will know which one has a serious problem right now that most financial content simply skips, and you will know how to add all of this to a retirement portfolio the right way, because the wrong account for some of these assets can quietly cost you thousands of dollars in taxes and Medicare surcharges. And here is the part most people miss. It's not just which assets you hold, it's where you hold them. We're going to cover both. Quick note before we go further. I'm not a financial advisor or a government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Why right now is different. Here's a question worth sitting with. What if the conditions that tend to precede a major market downturn are not coming, they're already here? Because the data says exactly that. Goldman Sachs recently raised its 2026 recession probability to 30%. The Shiller cap ratio, a long-term valuation measure for the S&P 500, sits around 38 right now. That level has only been exceeded once in modern history, right before the dot-com crash of 2000. The yield curve has normalized after a long inversion. Historically, that normalization precedes recession by 3 to 13 months. None of that is a prediction. I'm not telling you a crash is coming. What I am saying is that smart, prepared retirees look at conditions, not just headlines. And the conditions right now look a lot like patterns we've seen before. And here is something that will matter for the rest of this video. Here's the myth. If I own bonds alongside stocks, I'm protected. Here's the truth. In 2022, long-term Treasury bonds had their worst year in history, down 31%, at the exact same time stocks were falling 19%. Both sides of the classic 60-40 portfolio fell together. The safety net had a hole in it. So what actually holds up? Let me show you. The 4 assets worth knowing. 4 asset categories have a documented track record of holding value or gaining value during major economic crises. Not every one of them works in every type of downturn, but together they create a kind of layered protection that no single asset can offer on its own. The first is gold, not coins in an infomercial, the financial instrument. During the Great Depression, home stake mining, America's largest gold producer at the time, gained 474%, while the Dow lost 73%. That's not a typo. During the 2022 bear market, GDX, the Van Eck Gold Miners ETF, fell just 9%, while the S&P dropped more than 19%. Gold miners act like a magnified version of gold itself. They amplify moves in both directions, which means they carry real volatility. For a smoother option, IAU, the iShares Gold Trust, tracks gold bullion directly. It returned roughly 80% over the past year and carries a much lower drawdown risk than miners. The right choice depends on your comfort with volatility. The second is Farmland. The NCREIF Farmland Index returned positive 15.8% in 2008, the year the S&P fell 46%.
In 26 of the 28 quarters since 2000, when the stock market posted a negative return, Farmland posted a positive one. You don't need to buy land to access this. Farmland Partners, ticker FPI, is a publicly traded REIT that owns over 71,000 acres across 16 states. You can buy a share for under $15. The third is consumer staples. These are the companies that make the products people buy no matter what the economy is doing: toothpaste, soap, cereal, cleaning supplies. During the 2008 financial crisis, XLP, the Consumer Staples Select Sector ETF, fell just 15%, while the S&P fell 38.5%. In 2022, XLP was essentially flat, down less than 1%. It's up more than 9% so far in 2026 as investors rotate into defensive positions. Procter & Gamble has raised its dividend for 69 consecutive years. Coca-Cola has raised its for 64. These are not exciting numbers, they're reliable ones. The fourth is utilities, and this is the one that most other videos in this topic leave out entirely. XLU, the Utilities Select Sector ETF, has paid uninterrupted dividends every single year since 1999. In 2022, it returned positive 1.4%. And here's what makes utilities more compelling in 2026 than at any other point in their history. AI data centers are projected to triple electricity demand by 2030. The companies inside XLU, names like NextEra Energy and Constellation Energy, are direct beneficiaries of that structural shift. You get a defensive holding with a growth engine underneath it. Before I show you the one asset on this list that has a serious problem right now, drop a comment right now. Are you already holding any of these four assets, or is your portfolio mostly stocks and mutual funds? I read every single comment. The Treasury question nobody answers honestly. Now we need to talk about Treasury bonds, because the most common advice in this space is to buy TLT, the iShares 20-year Treasury bond ETF, and that advice needs a serious update. TLT is currently more than 48% below its all-time high. It's been in a drawdown for 5 years. It lost 31% in 2022. That was its worst year in recorded history, and it happened at the same time stocks were falling. Here's why. Long-duration Treasury bonds are deflation hedges. When the crisis is deflationary, like 2008, TLT is outstanding. It returned 34% that year. But when inflation drives the downturn, like 2022, long-duration bonds get hit from both sides. Rising rates push bond prices down, and with U.S. national debt now over $39 trillion and inflation still running above 3%, that structural risk is not going away soon. So if not TLT, then what? IEF, the iShares 7 to 10-year Treasury bond ETF, offers a similar yield with roughly half the drawdown risk. Its worst historical decline was 24% compared to TLT's 48%. That difference matters a lot when you're in or near retirement. For the most conservative option available, I-bonds through treasurydirect.gov currently pay 4.03%. They carry zero default risk. They can't lose value due to deflation. The limit is $10,000 per person per year. But for a retiree building a defensive layer, that's a meaningful position at essentially no risk. One more thing on treasuries that almost nobody mentions. Treasury interest is exempt from state income taxes. If you live in California, New York, or New Jersey, that exemption can save you over $1,000 per year on a modest position. But, and this matters, that benefit only applies in a taxable account. Inside a traditional IRA, all withdrawals are taxed as ordinary income, regardless of what generated them. Where you hold this matters. Which brings us to the part of this conversation that changed everything for Carol.
Let's bring this back to Carol. After that Tuesday morning, she did not panic. She did not sell everything. She built a plan, and the plan was not complicated, but it was specific.
On a $400,000 retirement portfolio, a 15% defensive allocation is $60,000. Here is how that $60,000 can be structured and why the account placement matters just as much as the assets themselves. Physical gold, IAU, belongs inside a traditional IRA. Most people do not know this. Physical gold ETFs are classified as collectibles by the IRS. In a taxable account, long-term gains on gold ETFs are taxed at up to 28%, not the standard 15 or 20% that applies to stocks. Inside a traditional IRA, that punitive rate disappears entirely. This is not a small detail. On a $20,000 position, it could mean $2,600 in extra taxes if you hold it in the wrong account. Farmland REITs, FPI, also belong inside a tax-deferred account, ideally a Roth IRA. REIT dividends are taxed at ordinary income, not qualified dividends. In a taxable account, those dividends increase your modified adjusted gross income. If that income pushes you above $109,000 as a single filer or $218,000 as a married couple, you trigger IRMAA. That is the Medicare income surcharge. It can cost up to $5,844 per person per year, and it works like a cliff. $1 over the threshold triggers the full surcharge. A Roth IRA removes that risk completely. Consumer staples, XLP, and Treasury ETFs work well in a taxable account. XLP pays qualified dividends. Many retirees in the 12% bracket owe zero federal tax on those dividends. Treasury ETFs in taxable accounts capture the state income tax exemption we just talked about. This is what Carol discovered. The assets themselves were not the hard part. The hard part was placement. Once she understood where to hold each piece, the whole structure clicked into place. The investors who come out of a downturn intact are not the ones who saw it coming. They're the ones who built the structure before the downturn arrived. The best time to build a shield is before you need it, because once the storm starts, the price of protection has already doubled. If someone you know is building towards retirement with everything in growth assets and no protective layer underneath, share this video with them right now. It might be the most useful thing they watch this year. Drop a comment and tell me which of these 4 assets are you already holding, if any, and which one surprised you the most. I read every comment. If you want to stay ahead of the decisions that protect retirement income, the ones most people only learn about after they need them, subscribe to this channel. That's exactly what this channel is for. Next, I'll show you how to stress test your entire retirement income plan against a 30 or 40% market drop before it happens.